Welcome everyone, how you all doing? Everybody up? Awake? Well look, my name is Ryan Chilcott, as you just heard, and I'm very excited about this discussion because today we have some real insiders with real deep knowledge, more than a half century of experience in capital allocation in real estate markets, between them in the trenches of real estate, to answer the big questions like, where is capital going? Where is capital going to go next? What are the most compelling asset classes? What are the most compelling regions? And how are macroeconomic signals shaping investors' strategies today? So please join me in welcoming Fahad Bin Hamdan.
Thank you.
Assistant Deputy of Investment at the Capital Markets Authority, the regulator here in the Kingdom. Fadi Katib. Fadi, thank you very much. CEO for the Middle East at BNP Paribas Real Estate, coming to us from Dubai. And last but not least, Paul Nyaru, partner at Deutsche Finance International, coming in from London, and very happy that I got his name more or less correctly pronounced. So, perhaps we could start with where, in terms of capital allocation, geographically, what's hot right now? Is geography something that the big capital allocators are considering when they're making decisions? And if so, where's the money moving to? And maybe, Paul, I could start with you.
Yeah, well, look, thank you for having us, and thank you for not butchering my name. Look, for us as a European investor, geography is becoming, I guess, less of a prime or primary focus.
Less.
Right? For us, it's been more about thematic, finding those thematic products, finding those asset classes where we believe, kind of irrespective of the noise, they're always going to succeed. So looking for those long-term dynamics. So for us, that's what's really important, and that's part of the reason why we're here in Saudi, right?
Fadi.
Well, I see a little bit less emphasis on geographies and more on thematics. We're a Europe outfit, but we're seeing more emphasis into specialist real estate sectors, from the living sectors, logistics, data centers, healthcare, and life sciences. And we've seen investors allocate less towards office, which was the dominant asset class for a long time, and more focused on specialist asset classes. And in so doing, the investors, especially in a high interest rate environment, they have partnered with specialist operators and developers to capture the demographic trends, whether it's e-commerce, an aging population in Europe, and so forth. What we're seeing is, these JVs, which were largely between investors that we cover in the Gulf and European or American operators, allows them to tap into the asset classes. And we're seeing also a quid pro quo, whereas historically the region has been a target for these specialist operators and developers to export capital internationally. But we're seeing a lot of these operators, logistics, data center developers, and residential developers come into the region, set up offices in the region, in Saudi Arabia, in the UAE, to try to tap local projects.
Yeah. Well, all you have to do is walk around Cityscape Global and also look at what's happening in Riyadh to see that real estate in the Kingdom of Saudi Arabia is, it's no overstatement to say, absolutely booming. So, Fahad, let me ask you, how have the capital market authorities' initiatives contributed to enhancing real estate financing for all of that development and diversifying the sources available in recent years?
First, thank you, Ryan, for having me here. Well, that's really an excellent question to start with this panel. Historically, the liquidity in the banking system in Saudi was, or used to be, sufficient for all financing need at that time. However, since the launch of 2030 Vision and its sequential initiatives and projects, the demand for liquidity in all economy has increased significantly. That's due to, as I said, the initiatives and projects. And on top of that sectors is the real estate sectors. Due to the mega and major projects that's been initiated with this vision, from redeveloping existing city to constructing new ones. So then there became a need and necessity to diversify the financing channels, not relying only on banking system or banking industry, but also utilizing the capital market tools. And I think the real estate companies have understood the difficulties that they are potentially facing. That's why they considered one of the top sectors who utilized the market, capital market in efficient way. And I'm going to bring some numbers to put everyone into the context. The asset under management in Saudi now reach 1.2 trillion. More than 300 billion, 320 billions are allocated in real estate investments. Yeah, and you can see how big is the chunk for that investment in real estate, which translated into a financing on that project in the sectors. And unlike other countries, the income-generating properties within this 300 billion represent only 10%. The majority of the real estate project, the majority of the real estate investments, it's actually being deployed in a developing project, and that shows the opportunities that the asset management are seeing and seizing in the real estate segment. The other angle is utilizing the debt market. The real estate companies could raise around 35 billion real locally and internationally from the debt market. That considered another tools. We've just recently launched our debt market a couple of years ago, and we think that the potential and the growth in this market will be promising in the coming years. Last but not least is the equity market. We used to have only just few companies in real estate that's been listed in our market, around 11. In the last 3 to 4 years, this number more than doubled. And we reached 24 companies. Their market cap represents 5% from the total market cap in the market, if we exclude Aramco from the calculation. But these numbers shows you that the real estate became a key element and mark in the capital market for that amount of money that they could raise in the past couple of years. That's from the traditional channels. Currently, we are opening a dialogue to receive new applications to the new technology for the tokenization and the blockchain technology. And I think we have multiple applications that have a final exposure on different type of assets, and we believe we might finalize this application at the early or the beginning of 2026. That's in a lump sum what sort of activities and facilitation the capital market provide to the real estate sector.
Wow, so really out there, sort of progressively moving in capital markets regulation.
Absolutely.
Thank you very much for that. Paul, if I could just get you to respond to that. There were a couple of numbers that just to understand how Saudi Arabia compares to, let's say, what you see sitting in London. You said 5% of the total market capitalization of the stock market, leaving aside Aramco, fair play, is in real estate. What would that be in London? I'm just interested. And then I believe, if I understood correctly, 10% is sort of, brownfield is the wrong word, but redevelopment, as opposed to 90% new projects, pure play development. How would that compare in Europe?
Yeah, look, in Europe, there is a very strong listed real estate market, as we know, but the private market is stronger. So I think for many years, the focus for capital raisers and investors has been focusing on the private market to raise and invest money. I think the big difference we're seeing between Europe and Saudi Arabia is the scale of opportunity here, right? In terms of kind of across all products, right? So if you're a developer, you're raising money for development opportunities, Saudi offers tremendous opportunity across all those asset classes, right? Huge demand and growing population, large undersupply across residential, industrial, office. There's a multitude of opportunity that you can capitalize on, which is different to what we're seeing across all the European markets, right? Where the regime is getting more difficult, right? There's higher interest rates, which curbs development. There's higher construction costs, which curbs development. There's more stringent planning and regulation, which curbs development, right? So we are a large developer across many European markets, but frankly, we're finding it much harder to develop at the same speed as we once did.
Yeah, very interesting. Okay, so Fadi, if we started by both you and Paul were talking about how really regions aren't sort of defining where capital is allocated right now in real estate. So if it's not regions, what is defining where capital gets allocated right now?
Well, it is where demand is the strongest and you have the highest shortage, especially in new stock. So, for instance, in Europe, and lots of similarities in Saudi Arabia, is the residential stock, quality residential buildings, multifamily, for developers to build, to rent out. So there's a shortage in Europe, and that's one of the key sectors that we like. Going to the technology front, with AI, with e-commerce, with the processing power that is required in Europe, and similarly in Saudi Arabia, data centers is a key asset class that we like. We think it's going to continue to witness very good rental growth and capital value growth. And there's a few centers in Europe that are key to this: London, Amsterdam, Frankfurt, Paris, and Dublin, and then some emerging centers such as Milan, Madrid, and the like. So there is a shortage for that. There's also a shortage for high-quality logistics and distribution centers. In Europe, it's for a pan-European distribution, driving e-commerce, and we see similarities here in Saudi Arabia as well, with a lot of established players in the West setting up warehouses and distribution centers here in Saudi Arabia.
Yeah, maybe just double click on some of the points Fadi made, which are really helpful. I think there's a lot of capital going to these thematic strategies, right? And a lot of capital going primarily to living and industrial, which creates a little bit of competition and saturation, right? So I think what we're also seeing within that is the ability to try and find niches where you can outperform the market, right? Because if everyone wants to build residential for rent or BTR, or everyone wants to invest in industrial, how do you beat the market from a returns perspective, right? 'Cause at the end of the day, we're both trying to raise capital to make money, right? And to create returns. So for us, what we're seeing is an increased volume of niche products within those larger sectors. A good example of that is flex living, right? Which is the merger of student accommodation and BTR to create studio units for young professionals and students. So that allows you to both tap into the capital markets, but also tap into larger demand pools.
Interesting.
Another niche in industrial we're seeing is buying industrial kind of warehouses and sheds, but applying them to tenants which are more kind of R&D tech friendly. So in that, you're playing both life sciences and industrial, and you have tenants which are going to stay for much longer because they invest more. They're labs, and they're doing kind of high value work in there, so they're more likely to pay more and stay longer, which is great as an investor. So I think that's a trend we're seeing. People are trying to capture interesting new strategies within the wider hot themes.
Yeah, and you mentioned, Fadi, to go back to, so we're now talking about thematics, and let's dig a little bit deeper. We're talking about residential and some of these niche categories. I mean, let's talk about data centers for a second, because I feel like you can't open the newspaper without reading about a data center getting open. I was in the elevator today with a guy from Amazon who was going to a data center here. Is that a promising space from your perspective? Is that a growth space when it comes to capital allocation? And where do you want to be there?
Yeah, I mean, and it's a very promising space. I mean, despite talk of oversupply, there's only 10,000 data centers in Europe. I mean, you compare that with the office stock, it's quite small. So the whole data center market is 1.2% of all real estate in Europe. So there clearly demands, again, as driven by AI. Some cities are very AI resilient, like London. They have 120,000 software engineers. 26 billion was raised in venture capital, to fund AI or AI-related companies. So there is a drive for that. There's also demand for space by, some very credit-worthy tenants. So it is expensive to develop data centers, but the demand is there. The tenants are there. They typically sign 10 to 20-year leases. So your tenants are sticky, and the income is indexed. And I'm saying this because I'm trying to do parallels with what you can achieve here in Saudi Arabia. It's clearly a sector that has a lot of promising potential. The leases can be indexed annually, your rent goes up, your tenants are very, very credit worthy, they're sticky, there's very little secondary available space.
Yeah.
So it is a counter-cyclical sector to be invested in. It's still a small part of the overall commercial real estate market, but it's definitely one to have a close eye on.
And Paul, if I could come back to that, if you think about data centers, so if we just heard from Fadi there that they're capital intensive, so that's perfect for some of the bigger players. In your niche, okay, then what's the opportunity and what's the Achilles heel of investing in a data center, right? I mean, everybody's piling in. What do they need to think about before they actually write the check?
Yeah, no, that's a good point. Look, the positives are clear. The demand is obviously there from both occupiers and the capital markets. I think the constraints and the challenges are the capital intensity, right? To develop these things, just huge amounts of capital that you need. So it's historically and currently been kind of uniquely positioned for the large players to develop. I think number two is a lot of the capex that you're investing in these things are in actual the infrastructure as opposed to the real estate. So is it a real estate trade or is it an infra trade? And there's data points of both of those. I think three is the power, right? To make these work, you need power, and there's kind of power scarcity in many markets. So and I guess overload of the grid. And then the last point is kind of what happens at the end of that 20-year lease to capex, right? AI is changing and evolving, and the tech is evolving all the time.
You could end up basically holding a dud, like something that's obsolete.
Correct. And I think that's a risk that I guess we haven't figured out. The way we're trying to play it as let's call it more of a kind of mid-cap player is we're trying to play the real estate side, which is kind of find the land, get the planning, and bet on the power availability, and then feed the hyperscale developers, feed a lot of the private equity funds, infrastructure, real estate, that are going to develop them to suit some of those
early
occupiers.
stage play.
Exactly.
Identify that site that you can change the planning permission for. Very interesting. Okay, well, Fadi, let's move away from that for a second. So, a lot of your LPs, if you will, are sitting in the Gulf, but they've been investing, obviously, in Europe. And so that's the focus. So how is what they're interested in changing right now?
Well, I think we're seeing some investors beginning to think of allocating to real estate equity. The bulk of investors, especially the institutional investors, were investing in real estate debt, primarily driven by the high income and being higher up the capital stack. So there's less risk investing in debt versus having the equity in a property or a portfolio of properties. So the returns, there's competition for real estate debt, so the returns are beginning to go down. Interest rates in the euro area have gone down, increasing that competition and lowering the overall income yield that can be generated. So we're seeing some of these investors shift some allocations into real estate equity, which is very good for our industry.
Because?
Because especially with regards to core capital, that is capital investing in income-producing property. And that is the backbone of any well-functioning real estate market. core capital is the exit capital for value-add strategies and opportunistic strategies that are covered by Paul, for instance. So you need someone to take out your investment. You take development risk, or you do a restructuring or repositioning of an asset or a portfolio, you need to take out money. And in addition to that, the transaction sizes, the last few years have been quite small. Only 7% were over 100 million euros. And that is because there was a two-tiered market. One was the family offices buying income-producing assets, and then the sophisticated institutional investors, the sovereign funds, the pension funds, and some financial institutions doing these JVs, getting development upside, getting that nice yield on costs and IRR from investing through these strategies. So we're seeing that core capital coming back. We're seeing year to date about 30% of transactions in Europe were 100 million or above. So the average transaction size is increasing. Investors from the Middle East are still cautiously coming back into Europe. The region used to account for anywhere between 4 and 8 billion euros of transaction every year in commercial real estate. Year to date, it's about 1.5 billion. So we still have some ways to go before the market recovers.
Paul, is that what you're seeing?
Yeah, look, what are we seeing? We're seeing there is a lot of competition from capital, right, for other sectors and other geographies. So Europe real estate isn't kind of the top of the list, at least on the equity side, right? There's been credit, right, to your point. There's been kind of core plus in the past, but I think everything we're seeing, the data points we're seeing is we're going to start seeing more flows of capital back into European kind of equity. I think what we need to realize is we're a little bit of a kind of a new world, so it's kind of trying to find a way to navigate what this kind of new world is, right? There's higher interest rates, there's more noise and uncertainty, so you're having to kind of pick, back to what we said earlier, pick the products you want to focus on, but also pick products that you think you can actually value create, right? Because it's not enough to rely on the cycle in the economy anymore, right? Because it's really hard to kind of know where we are. But it's more about, can you actually roll up your sleeves and drive proper value, right? By picking the right sectors and building those platforms, right? Building the operations, right? So you're not just relying on the real estate to do the work, you're also relying on the operation to do the work for you as well. So it's kind of playing both those different trends.
Fadi, a question for you. So I think it was a Bloomberg story I read today about how some Gulf developers are now, some of the best known, are now deploying capital in Europe, or increasingly, allegedly deploying capital in Europe on the back of what's been a pretty extraordinary boom in property in places like the Emirates, here obviously in the Kingdom of Saudi Arabia. Is that what you're seeing? Is that indicative of what's going on?
Yeah, I mean, there's not a flood of capital going there. It's going there very selectively, and it's chasing opportunity. The opportunity will drive the investment. It's not like they have a directive to, invest in Europe or the US and so forth. So,
and it's not necessarily a trend.
It's not a trend, and you also have to take into consideration, we're seeing that some of these developers, some corporate players, they have international investment teams, and these teams, when they're underwriting an international asset, they have to compete for capital with their investment committee, versus the teams that handle local projects. So whether you're in Saudi Arabia, the returns are still the driver, and the returns in Saudi and the UAE are still higher. So unless you have a directive to diversify out of the region, you're going to be very selective about picking the opportunities outside the region.
We started the conversation talking about macroeconomic signals, which ones are important. You mentioned interest rates coming down and that changing the market a little bit and the opportunities. I would be remiss to not ask, everybody, if you read the news today, is concerned about a possible market correction in equity markets. What would that mean in terms of shaping allocation in real estate over the next, say, 3 to 5 years?
Well, I think, real estate going back to pre-22, when interest rates were 0, a lot of institutional investors doubled their allocation to real estate because they had 8 to 10 or 12% portfolio target returns. And the only way they were able to achieve that was to increase their allocation to real estate. And, you know, real estate was the king of income and the king of return for a long time. So the other asset classes were a little bit behind, especially on income. Whether it's fixed income, dividend stocks, and money market instruments and so forth. So now that that market has corrected, real estate has to compete on its own merit. So if if the stock market goes down, from a return perspective, stocks are going to be cheaper, and whether that's going to drive any capital into direct real estate is anyone's guess. I mean, if your equity portfolio drops in value, your direct real estate allocation is going to increase as a percentage of your total portfolio. So it's tough to call.
Just to jump in, we saw kind of case in point of that during COVID, right? So we have global LPs, a lot of them institutions and family offices that hold these balanced portfolios, and exactly that happened during COVID, right? So you saw the equity values fall, which made real estate as a percentage of their portfolio increase, which meant they would turn around and say, you know what, we're actually over-allocated to real estate this year, and we have no more commitments left, right? So I agree with that, and we kind of saw that during COVID. I think to the point of rates, do we think rates are going to continue to decline? I think we're reaching kind of a stabilization period in Europe. Maybe there's a little bit longer to go on that, but do we think we're going to get back to where we were previously? I don't think so. I think we're kind of living in this kind of new norm where we're going to have to figure out ways that we can achieve those returns with a higher cost of debt, right?
Yeah.
Which means, I guess, as you also alluded to, there's a lot more competition, right? Competition by region, competition by asset class, equity versus credit. There's a lot of different products investors can invest in, so we have to work harder to almost kind of prove a point as to why to come and flood back into real estate equity.
But I think the key conclusion to this is that instead of being a leveraged investment, as real estate was for almost 15 years with 0 interest rates, investors are going back to the basics. Real estate is all about fundamentals, right? You have a shortage of student accommodation. You need to build that or convert obsolete office stock into student accommodation. So it's all about the fundamentals. It's not, you buy it at 4.5% cap rate and you finance it at 2% all in, you can distribute 5, 6, or 7% to your investors. That game's gone. Either you invest directly as a family and you're investing for the future generations, so capital preservation and some income, or you're taking real estate risk, looking at supply and demand, occupancy, rental trends, and the likes.
Yeah, and we heard Fahad there talking for a moment about how the KSA is going to look at tokenization and allowing that. What do you make of that? Not necessarily here in the kingdom, but in general, what are you seeing? Well, maybe Paul, I'll come over to you.
So the question was what? Tokenization?
Yeah.
Yeah, so look, what do we see? There's two sides of tokenization, right? You've got the occupier side, right? Do you allow tenants to actually pay with tokens, right? With token currency. We've seen little bits of that, right? But that hasn't been fully adopted. On the capital market side, we've not seen it in kind of the private equity side of things in terms of actually raising money through that channel.
Yeah.
I think what we're seeing is kind of studying the whole market as a whole to figure out how to use the tech to kind of to facilitate capital raising and facilitate investing. But for now, I guess what we've seen is, more tokenization to raise money from the retail channels, right? I think we see that for sure, but we see it less in kind of our fund LP type world.
And I ran into one of our competitors, and he was telling me, I just went through tokenization training session. I think it was yesterday or today. And he said, we're going to be out of a job soon. I told him it depends. Aside from the technological impact that Fahad you alluded to, I think tokenization fractionalizes ownership in real estate. So for any banks or financial institutions that want to create funds, tokenization is a good tool for them to distribute shares in that funds. For those sponsors of a particular property or portfolio, tokenization is a way to attract a larger number of smaller investors. So it's almost the democratization of access to real estate.
Yep.
However, for the pure institutional investors or investors that want to own 100% of the equity in any particular asset or portfolio, I don't see them coexisting with 2,000 retail investors. But there clearly is demand. The technology is worth capturing, at least from an institutional side, but definitely to provide retail investors to access.
Paul, continuing with investor strategies, if you look at core versus value add versus opportunistic strategies, what are investors favoring right now?
Yeah, look, it's an interesting question. I think it's kind of a mix, right? I think investors are favoring value-add opportunistic returns, i.e. 15 plus IRRs, the higher the better, but with core plus risk. So they're trying to increase returns but reduce the risk, right? And I guess that's what we're seeing from all our LPs, right? So when we're raising money, they're pushing us to try to achieve those higher returns but take less risk, so less planning development risk, much more income business plan risk.
And Fadi, how are you assessing risk versus return today across sectors?
It is again, back to real estate fundamentals. So we certainly like the alternative sector. I mentioned data centers, the living sector, purpose-built student accommodation. There's shortage in Europe, not only in the UK, for that asset class. So your yield on cost as a partner with developers is quite attractive versus buying existing stabilized stock. Life sciences is also a sector that we like. In the end, the risk-return trade-off depends on the profile of the investor. So we will see that the bulk of the end investors, the family offices and ultra-high net worth investors, most of them want income, and they want to benchmark that income against what other asset classes or deposit rates, what they can achieve in terms of income. And then at the other end, you have the sophisticated financial institutions, the funds, the sovereign funds, the pension funds and the like. And some of these are comfortable with taking more risk, either doing repositionings and targeting anywhere from 12 to 15% returns and onwards. So it depends on the profile of the investor.
Paul, what sector are you seeing the biggest capital? In what sector are you seeing the biggest capital flight?
Yeah, I guess there's definitely two, but if I were to pick one, it would be living. And the reason I see living is, I guess, three key factors. One, kind of urbanization and housing formation, right? That's huge. A lot of people living alone and living alone for longer. Two, increased preference to live, right, and rent, right? Housing is becoming less and less affordable to buy. And that's creating this kind of long-term rental product. And then number three, we've gone through large period during COVID of lack of supply, right? Supply was either unfeasible or just very difficult, right? Which creates a huge undersupply of housing all across the globe and various markets in Europe. So us as a house and the capital that we are raising and investing is going to try and kind of tackle that undersupply in various different ways, and that varies from country to country, right? So in countries like Denmark, we're doing student accommodation because there's 8 students to every bed, huge shortage. In the UK, we're investing in flex living because, 5% of all the rental properties in the UK are institutionally owned and managed. There's a huge demand for the kind of third-party institutional capital to come in and develop platforms, and I can go on and on.
And when you talk about commercial real estate, it's interesting, you didn't talk about secondary commercial real estate, some of these offices, remote offices that were getting built outside of cities. You hear about them kind of just empty.
Yeah, well, look, we've seen over 21 to 24, almost like a 60% decline in transactional volumes in the office sector.
Yeah.
I think Fadi mentioned it earlier. Office sector was the darling of real estate for many years, the largest investment sector. I think now you're seeing a bit of a bifurcation in that sector. I think we're seeing over the last 12 months actually a slight return of capital to the office market, but only for the best.
Yeah.
The best locations, the best products will yield both investors and demand, but for some of the secondary assets, there's almost no liquidity. So what we are seeing in those, to your point on regional assets, is can you buy them and create alternative forms of value? But we've seen many cases in great locations.
Like what? So you take this office building in the middle of nowhere, like a secondary office.
And you create a resi asset, or you build a data center, or student accommodation. Yeah. But in many of the sectors, we found that actually, even though you can buy it for basically free, i.e. you can buy the cost of land for free, by the time you demolish it and build the construction in some of these locations, the numbers don't stack. So it's just basically worthless, which is why there's a lot of stranded assets across regional cities globally.
A lot of investors have given the keys back to the banks on these secondary properties.
Wow.
So yeah. Or the other option is to convert them, as Paul mentioned.
Let's switch gears. Quick question for you, Fadi, and then we'll come back to our regulator. What matters most for building long-term confidence in emerging markets, emerging real estate markets?
I think I would take the UK as example as one of the most international markets for real estate out there. And barring aside, the current political climate and the fiscal climate in the UK, it is still a beacon for international investors. I mean, there are several elements, right? There is a lot of market depth. There's multiple players. There is rule of law. It's landlord friendly. You can acquire property, and rents are reviewed only upwards. So there's plenty of dynamics that favor the UK and London in particular to international investors. And there's a lot of market transparency. I mean, we are present in France and Germany, and Germany is a lot less transparent market than London, for instance. In London, if you lease a building or if you sell a building, every broker, every agent will know what is the rent that the tenants paid, what is the cap rate at which the building was sold. So there is that transparency in the market that creates that depth, that liquidity. So you know that if you invest in the UK and London in particular, you'll be able to exit if you have a 5-year horizon or a 10-year horizon. And I think the other element is financing. A lot of debt, non-banking debt providers are based in London. So to what Fahad was alluding to, the capital markets and the debt financing, you need to have access to non-banks to get financing, and that's very important. So modeling, on the basis of what London has done, I think is what I would think.
Let me come to you, Fahad. So you heard Fadi there talking about sort of London is the gold standard for international investment in real estate. As the regulator here, the CMA, what's it doing on the investor protection front, on things like that, to safeguard investments and encourage that international incoming capital?
Well, you can see it in a different angle. The CMA has worked in several initiatives that conclude the following. First, we increased the transparency and the disclosure on the offering document. And the offering document, as the gentleman knows, is the contract where the investor will sign and agree on all the disclosures as being made and pay his investment. So we made sure that the investment strategy is clear, the exit strategy is clear, the risk profile, all type of important and material information where the investor can make his decision on a formative information. The second angle is to have a very high standard corporate code where you distinguish and segregate the duties between executive management and board members and related parties and shareholders. Everyone knows exactly what his duty, what his obligation. Third, but not last but not least, is the regulation of class action suit. And it's, in a simple language, is to facilitate the litigation procedure where the plaintiff is a group of people. And that work very well when the investors are in a listed securities, either equity or fund, and there is 1,000 of people, so you can get them all together and submit their case, where the process at the court is going to be more efficient, and they get the decision very fast.
Very interesting. Okay, so we just have another minute and a half, but Paul, real quickly, what single signal tells you a market is truly ready for long-term capital?
Yeah, well, look, it's what everyone said on the panel, but I think for us, it's the capital markets, where we haven't invested in a certain market. It's because we haven't felt the depth of liquidity is there. So we've kind of turned away to say, you know what, in a bad market, what do we do with our investments? We're stuck. So for us, that's the key focus when we're investing.
And Fadi, considering all we've just discussed, if you had to pick one theme for your next big allocation, what would it be and why?
I've mentioned data centers, but we also like prime offices. I think that market is beginning to recover. You have good rental growth prospects between 3 and 6% in key cities. You have very low vacancies in central business districts, so we like that sector, aside from data centers and the others.
And Paul, your answer?
So for sector, I'd say more rental living, and especially affordable rental living.
Okay. All right. Fahad, Fadi, Paul, thank you very much. Please join me in giving a big round of applause.
Thank you so much.